Thank you. We are honored to have you with us as we reflect on our journey and look ahead to the future of investing in India. To kick off today's proceedings, it is my privilege to invite on stage Mr. Dheeraj Reddy, Managing Director and CEO of HDFC Securities, to deliver the opening address.
Good morning, one and all. Thank you so much for joining us this morning. I am happy, delighted, thrilled to share with you our 25-year story and remarkable achievements. I'll take you through this small presentation, but personally also it's been a fulfilling experience for me. I have been CEO of this company for last 10 years. May 2015 when I took over, and last 10 years have been absolutely great experience. We have navigated ups and downs of markets. We've navigated the regulatory changes. We've navigated COVID and also tough competitions coming from the tech-led brokerage houses. So in a nutshell, this has been really a fulfilling experience for me and my colleagues in last 10 years. And of course, our 25 years of journey has been really phenomenal. We started the organization sometime in April 17, 2000, and now we have completed our 25 years, and we'll share with you the story. But before I talk about HDFC Securities, I think we have had a remarkable growth in India in last 25 years. GDP has grown by 9x. Financialization of saving has played out, particularly in the last 10 years. More so, equitization of savings has played out in the last 10 years, particularly post-COVID. If you look at it, how our industry has evolved in terms of number of demat account holders, number of active users, or SIP throughput value on a monthly basis, 26,000 odd crores. Mutual fund AUM growing from 8 lakh odd crore to 66 lakh crores. Now, in 2014, it was just about 8 lakh crores. Nobody believed that it could go to 66 lakh crores by 2025, and a long way to go. This is just about 30% of the deposits. It used to be 10% of the deposits in 2014. Now it is 30% of the deposits. In many developed countries, AUM is always a multiple of the deposits. So that way, a long way to go, but yet, I think we all can take pride that mutual funds per se has become a household name. Whichever social forum you go and meet people, they ask you about what kind of schemes they should be investing in. And similarly, we've seen the rise of alternate investment products also, whereby people have started to explore products like portfolio management services, alternate investment funds, and there also we have seen almost 30% plus CAGR, and it has grown significantly in last 10 years. It's a newer asset class. People are yet getting assimilated to it. Ticket sizes, higher ticket sizes of 50 lakhs and 1 crore are also somewhere a filter for the investors. And now SEBI has introduced SIF 10 lakhs and above. I think that will be one asset class to be watched for more and more financial inclusion, equity as an inclusion. So in last 10 years particularly and last 25 years, we have seen evolution of financialization of savings and equitization of savings. We'll take you through the quick journey. Here is our quick 25 years journey. And very recently, last year, we launched HDFC Sky. Financialization savings to equitization of the savings, which means getting more comfortable with equity as an asset class.
You can do a short sell provided you have the securities, or you can borrow it from the SLBM market.
The impact on Nifty is very clearly now driven by macro factors.
For the first time in 4 years, we have gone overweight on consumer staples.
रिटेल इन्वेस्टर्स के लिए अगर लॉन्ग टर्म में अच्छा मिड कैप का शेयर हम लें और पोर्टफोलियो में रखें तो वहीं पे सबसे ज्यादा अल्फा या सबसे ज्यादा पैसे बनते हैं।
जो हाई ट्रेडिंग पीएमएस है उनका इम्पैक्ट जज करना है और उसको काफी क्लोजली इवैल्यूएट करना है।
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Thank you so much. You can see that in last 25 years, we have done so much, and industry has also grown leaps and bounds. We take significant pride in our vision to help our customers to be successful. So our motto always have been to put customer at the center stage and help them to in their journey of wealth creation. So we focused on the research, we focused on the digitization as we evolved. Even in the early 2000s when we started with the 3-in-1 account where demat account, trading account and banking account can be linked and seamless services can be given to our customers. Over the years, we've not just remain focused only on broking space. We've also expanded into the distribution of various products like mutual funds, insurance, portfolio management services, alternate investment funds, NPS, and many other products. We have excelled in many of these areas, a long way to go to make mark as an entity. But few numbers to share with you. Last year, we did top line of 3,265 crores. And also a profit after taxes 1125 crores. Last 5 years we've been growing at 31% CAGR on top line and on bottom line 24%. We do it with significant purpose. We do it with the social responsibility. We do it with the objective of helping our investors. I know that there were exuberance in the derivative space in last few years. That can be substantiated with the point that NSE is a #1 exchange in the world when it comes to derivative contracts. Whereas if you look at in the cash segment, it is #8 exchange in the world. So a long way to go in the cash segment. We've also leveraged to the potential margin trade facility that was introduced in 2017 by the regulators. And today we are one of the large players with the double-digit market share in that space also. We believe in ensuring that our customers are at the center and we help them to create wealth. We've also been adding customers. Today we have about 7 million customers, and we strongly believe that we can continue to do more in this space. Very recently, we've launched few digital properties like HDFC Sky, which is a discount broking platform. We also have launched HDFC True, which is an advisory services. We are fully committed to disrupt the advisory space and offer best in the class advisory services to ultra HNI customers who deserve to be treated differently, who deserve honesty and expertise in the engagement. We have seen in last 25 years significant shift in the consumer behavior also. The industry has not just evolved because the regulators, exchanges, clearing corporations or the brokers have done their bit, but also it has changed because there was an awareness, different level of awareness and different level of understanding about the financial products and equity as an asset class. I think all of you have played a significant role here. Media, influencers have also played an equal amount of role to democratize the financial assets and equity as an asset class. That get reflected in the number of investors growing in double-digit CAGR. So we strongly believe that we still have a long way to go. We have progressed where we had an information arbitrage in favor of institutional investors a decade ago, and now that information arbitrage is not there, and information is easily accessible, available to all retail investors, individual investors, HNIs, as much as it is available to the institutional investors. But we still believe that we need to do a lot more work along with you to ensure that we cascade the right set of information. We guide our customers well so that they understand how they can grow their wealth with appropriate risk management, and also ensuring that they have a well diversified portfolio as per their risk appetite and asset allocation. We believe the digitization in India, particularly Jan Dhan, Aadhaar and mobility, has also changed the opportunity and landscape and ensured that we can reach every nook and corner of India and democratize the investing as a landscape. We are today able to onboard our customer through 5-6 minute digital journeys, and all our customers, 99% of our customers are acquired through these digital journeys, and 90% plus customers actually engage with us only through digital properties. Only very few customers are reaching out to our relationship managers or our centralized dealing desk where they execute their orders through the on phone. Otherwise, 90% of the plus customers are actually dealing with the digital properties only. So digitization has actually played a very critical and important role. And we believe now with the advent of artificial intelligence, particularly generative AI, we are well placed to add significant value with the real-time insight backed by our research and domain expertise. And we believe that the equitization of saving is something here to grow, and we are on the cusp of exponential growth in equitization of savings. Let's go through another video.
25 कोई सादी सी गिनती नहीं होती। ये तो ख्वाबों की पहली चाबी होती है। कभी सोलो ट्रिप का जुनून और कभी चीयर्स के साथ पहले जश्न की गूंज। यार की शादी, आंखों में सपने नए, दिल पूछे खुद से अब मेरी बारी कब आए। किसी के लिए ये पहला कदम है अपने भविष्य को संवारने का।
मिस्टर एंड मिसेस कोठारी, आपने तो कमाल कर दिया।
और हमारे लिए ये कदम है आपको आपके मकसद तक पहुंचाने का। जिंदगी के हर मोड़ पे HDFC सिक्योरिटीज है आपके साथ।
Investment in security.
We still believe that we have a long way to go in achieving our vision of transforming our customers' financial goals into a tangible success powered by our digitization as well as expertise. So we will continue to strive hard in achieving this goal, this vision, and we believe our best is yet to come. We look at the future with purpose, with responsibility, with vision of transforming the lives of our customers and Indians at large. Thank you so much. Thank you.
Thank you, Mr. Relly, for that inspiring address and for sharing the remarkable journey of HDFC Securities. At HDFC Securities, our commitment extends beyond business. We believe in giving back to society and empowering communities. With that in mind, we are glad to unveil our latest corporate social responsibility initiative and the new financial literacy LMS app. I would like to invite Mr. Dheeraj Relly, MD and CEO, Mr. Ashish Rathi, our COO, and Ms. Nitika Bhatia, our CHRO, for the unveiling. May I please invite Mr. Dheeraj Reddy to join us on stage first to talk about the initiative.
So as you have witnessed that we've had a remarkable journey in last 25 years as HDFC Securities and at an industry level and India level. I believe that our responsibility doesn't end with the just growth and democratization of investments. We also need to actively contribute towards the society. In last few years, we have spent more than 100 crores on the CSR initiative. I think this is commendable that we could able to contribute to the society, we could able to give back to the society. When we were having more discussion around this area, that what can we do more for our customers, Indians, and how we can contribute more. We realized that we may not be able to make significant impact to 1.4 billion people through the certain amount that we use as CSR, but when it comes to knowing the money, we thought that we can, with our expertise, with our domain knowledge, and of course digital platforms available with us, we can really focus on democratizing the information, making the information around financial products and investment products easily accessible to our customers and to every Indian. With that as an objective, we are launching Know Your Money, and that's what you will witness. And we look forward for your support also to ensure that we are able to cascade the right set of information that resonates with all possible segments of Indians and customers. Thank you.
Thank you, sir. I now invite Mr. Ashish Rathi, our COO, to share some more details about the initiative with us.
Hi, this is Ashish Reddy here. First of all, would like to thank you for taking out time and coming out for this event. I think so 25 years of HDFC Securities and the CSR initiative. So I'll just briefly update on what the CSR initiative is all about. So as HDFC Securities, what we have done is, we have tied up with 3 esteemed organizations. Wagon Skill Development Limited, then we have tied up with Empower Her Foundation Limited, and Access Livelihood Foundation Limited. The point is that we want financial literacy to reach 2 corners of India. So the idea is it has to be a mix of digital as well as physical. Now, Know Your Money is the launch of state-of-the-art app as well as the learning module on the web. Now, Wagon Skill Development has developed it for us. So that is the part they've done. Now, this web platform as well as digital app is launched in 10 languages, including Hindi and English. The idea is on this app or on this financial literacy module, people who are daily wage earners, students, household workers, they can actually get onto this app or the web platform, get financial literacy in terms of basic needs like banking, could be financial planning, retirement planning and everything. So this is the entire digital piece of it, but however, our efforts are not only concentrated on the digital piece. We are also looking at how can we touch base them with physically. Now on this, Empower Her Foundation actually has helped us out train over 1,000 teachers across 500 schools so that we can touch base with approximately 1 lakh students across the board. Further, Access Livelihood Foundation is driving community living by way of training over 300 digital Sakhis to educate more than 1 million individuals at a grassroots level. Since January 2025, our combined efforts have already reached over 50,000 students in government schools with plans to expand to 250,000 individuals in the coming year. So it's an effort. I mean, India is a very large population country, but it's an effort in the right direction to see to it that everyone gets financially included. However, it is a long way forward and we try to make a difference through whatever means we can. It could be digital, it could be physical, it could be on the ground training everyone. That's it. Thank you so much.
Thank you for sharing those details, sir. I now invite Ms. Neetika Bhatia, CHRO HDFC Securities, to say a few words about the initiative.
Thank you everyone once again for being here. I think Ashish mentioned the details about the initiative, and what we're seeing on ground is actually the impact of these sessions that we're doing through Know Your Money. So the teachers who are delivering these sessions, the teachers, the students, and even the parents and the larger communities that they're able to touch. Now through this, they are able to have that confidence to be able to, say for example, set their financial goals, be aware of financial frauds, which again is very, very important in today's world, and be able to take the first steps towards financial investments. And the way we look at it this year, we'll continue to enrich the initiative through interactive content. So we're working on comic strips, on video series, which are very easy to understand for this segment, easy to understand, easy to interpret, and they are able to again be aware of financial frauds and how do they understand the complex financial concepts in a very simple kind of manner. And overall, as part of HDFC Group, I think we are in a privileged position to be able to take these steps and work towards overall financial inclusion and financial literacy in the country. Thank you.
Thank you so much, ma'am. We would now like to present a short video showcasing our CSR initiative.
Did you know 7 out of 10 Indians are financially illiterate? It's more alarming in rural India. No education, no resources, they're left in the dark. Financial illiteracy means bad choices, no saving and falling for scams. It's hurting millions. It's time to change this, and it starts now. Introducing HDFC Securities Know Your Money. Our mission to make financial literacy everyone's right. Help millions of Indians achieve financial literacy through on-ground and online efforts. Available in 16 languages, accessible anywhere, from mobile phones to tablets to in-person. Reaching over 5 million people every year. 1 lakh plus students, 1,000 plus teachers, and thousands of communities have already been reached. With HDFC Securities Know Your Money, we would educate, empower, and elevate millions of Indians to make financial freedom a reality.
On behalf of HDFC Securities, I thank our leadership, our partners, our teams, and every individual who has contributed to this journey. Together, we are building a financially resilient India, one informed decision at a time. Continuing our journey of innovation, we are excited to present a landmark data report, 25 Transformative Investment Ideas by HDFC Securities. May I invite Mr. Reddy back on stage to officially launch the report and share the vision behind it.
As I just spoke some time ago, that we would like to transform the aspirations and financial goals of our customers into a tangible success. That's our vision, backed by our expertise and digital offerings. We thought, what could be a better way to celebrate our 25 years other than offering a solid stocks recommendation backed by our last 25 years of research expertise. So that's where we started to work on it. Varun Lochap, who is our head of institutional equities, and I had long chat along with our analyst on this piece. We thought, let's look at what kind of recommendations we can make, what kind of companies, what kind of stocks we can share with our customers, prospective customers, and everyone, where they can invest in these companies and create wealth over the long term. Unfortunately, in India, most of the investors are investing through some recommendations coming from the not so well researched researched products. So they have all been investing in through some kind of a tip-off they get from their friends, acquaintances, influencers, and so on. Brokerage house like us at HDFC Securities, we put our full might behind these research. We go and do a deep dive analysis of bottom up on all these companies. We today have more than 250 stocks under our coverage in institutional equities, and in the retail research we do technical research, derivative research, and also techno-funda and fundamental research of more companies. And we thought that let's solve this problem. Everywhere we go and meet people ask us what are the stocks we should be investing for a mid to long-term objectives. We thought that it will be a great idea to commemorate the 25 years of HDFC Securities by coming out with a solid recommendation that customer can own and invest through us also. So we've created a basket of 25 stocks with equal weight so that customers can invest in these stocks, and they can invest in one click also through our platforms. Otherwise, they can pick and choose, and they can invest also in all these stocks, or progressively, as they feel comfortable with it, they can invest in these stocks. So these are market cap agnostic, these are industry agnostic. So our aspiration was to cherry pick the top 25 stocks from our coverage that can help customers to create wealth. Varun will give you more details and insight about these 25 stocks. Thank you.
Thanks everyone. Thanks Dheeraj for setting the context. So, as Dheeraj said, the idea was, to kind of leave certain ideas and, help our investors kind of make money from some of the changes which Indian economy is going through. And, 25 fortunately is a good number from a portfolio perspective also. So, we thought it's a great occasion to launch this sort of a basket where, we believe 25 to 30 stocks is the ideal diversification, at the same time concentration which one should aspire for in their portfolio. Typically, we have seen, a lot of investors either having, very, very concentrated portfolios with only 5 or 7 stocks, which always increases the risk profile. Or in certain cases, we have seen, people holding 100 stocks basis recommendations from various players, and therefore, they tend to lose on the upside, even if they get some of those stocks right. So first is, you should have a balanced portfolio. In this, 25 stock basket, we have got, almost an equal number of large caps and, mid and small caps. So there are around 13 large cap ideas and around 12 stocks from the small and mid cap space. It is also well diversified across sectors. So while, the idea was not to pick stocks basis, just, trying to create a basket around Nifty composition. But, when we look at, if you see the basket, almost 20% is in consumer, around 16% is in BFSI, and there is a fairly good representation from all the key sectors of the economy. So in that sense, it's a very well diversified sector portfolio across both the market capitalization as well as the sectors. What were we looking for when we were picking these stocks? We thought, let's make a portfolio which is with a 3 to 5 year kind of a time horizon, because not all our investors are looking to rebalance, their portfolio and looking for just 1 year kind of a portfolio. So this portfolio has a 3 to 5 year sort of a time horizon, which I think is the minimum time horizon one should have when they are investing in equity, so that they can benefit from the compounding. Second, we looked at, all of these stocks, 25 of them are within our coverage. So we already do extensive research on them day in, day out. As Dheeraj said, we cover 250 stocks. So these are cherry picked ideas from, 25 of the best ideas we believe from those 250 stocks. If you look at the earning growth, which we are forecasting for these 25 stocks, is almost 31%, which is almost 3 times what is the earning growth projected for Nifty, 2.5 to 3 times. So these are, I would say a growth turbocharged kind of a portfolio. We are looking for above average kind of growing companies, but at the same time, while valuations also you'll have to pay higher than what the Nifty is. Nifty is currently trading at around 20 times. This portfolio is around 35 times. So you are paying around 1.5 times higher on a PE basis, but you are getting 2.5 to 3 times the growth, of the entire market, which means that, the PEG of this portfolio is much superior to that of the overall market. And coupled with that, we have been very, very conscious of the quality of this portfolio. So average ROE for this portfolio is 19%, which is much better than the market average. If you look at, we have been very conscious of the corporate governance of these companies, of the management quality, of the balance sheet strength. These won't be very leveraged companies. So all of those quality filters we have been very, very, particular about. If you look at, the other way when we were constructing this portfolio other way to think was, what are the themes that we are betting on from a 3 to 5 year view, in terms of how, Indian economy is evolving, and, where should we be positioned. So if you look at, this has a good mix of some of the large sectors where, sector leaders are very, very strong, and, we believe they will maintain their leadership in the next 3 to 5 years. And certain sectors actually lend themselves better to, the big player getting bigger. Financials or, oil and gas, these are some of the sectors where, the big company tends to get bigger over a period of time if they are run by quality management. So, we have got names like Reliance, SBI, L&T, Maruti, NTPC. They are all sector leaders in their respective, industries, and we believe their sector leadership is not going to get challenged in the next 3 to 5 years. The second was, can we pick some high growth companies now, beyond the sector leaders? It could be a number 2, number 3, number 4 company in those industries which are kind of growing much faster than the sector. So it could be a market share gain story, or it could be, some niche sector, niche space where, some of these smaller companies tend to have an advantage compared to the larger companies. So if from that basket, we have got names like, MCX, which is an exchange. Now, that's a sector where you don't have large caps. So, it's a mid-sized company. Similarly, Shobha Developers on the real estate side, we believe has got very strong growth plans over the next 2 to 3 years. So these are very bottom-up ideas where we are very confident on next 3-year growth. Names like Navin Fluorine, Century Ply. Some of these sectors don't have large caps, like, chemicals, building materials, but we believe those are good sectors to own, again, from a, 3 to 5 year perspective. So we have gone to mid caps where the need is, where we believe, the mid cap companies in themselves might be leaders in their sector, but just that the size of the companies today is not big enough for them to be a large cap company. Third is on the capex and infrastructure. We have seen that theme continuing in the last 3 to 4 years, and we believe India will continue to invest significantly both from the private side and from the government side on capex and infrastructure, even in the next 3 to 5 years. So names like L&T, Cummins, Jindal Steel fall in that bucket. Then manufacturing, China plus one story, it got one leg of boost post-COVID. We believe, the recent tariff situation might again present some interesting opportunities for Indian companies from a next 3 to 5 year perspective. So, we have got some names which fall into that sort of a bucket. So names like Navin Fluorine, Amber Enterprises, Samvardhana Motherson, which we believe will be net beneficiaries of, of global market share sort of gains coming their way because of supply chain shifting away from some of the other countries. Then obviously internet, new age, digital, those are, we believe themes here to stay, and their share in the overall market capitalization in India will increase. So names like Eternal, InfoEdge, we believe are very solid plays out there run with very strong managements and great business models. And lastly, renewable energy. Again, this is, we believe, a decadal sort of a trend which is here to stay. So names like NTPC, which also have now a fairly sizable green energy portfolio, Power Grid, which is going to benefit from the transmission business significantly and has been a consistent company. So, so basically, it represents most of the themes which are prevalent in the economy, this portfolio. It represents a good mix of sector leaders as well as, some of the, mid-cap companies which are higher growth, which tend to boost up the overall growth of the portfolio. This is the list. As I said, if you look at even among the large caps, the names like Reliance, SBI, L&T, they all have a fairly solid earning growth, compared to the Nifty average. So in large caps, one has to be slightly more, valuation and valuation conscious. So some of these names we believe have now become attractive, and therefore, in large caps, typically what we do is out of the 50, 60 large caps which we cover, we typically try to keep valuation as a strong filter out there, because they tend to go through cycles. Like Reliance 5 years back was very expensive. Today, after 5 years of stock not going anywhere, we believe valuations have become, more reasonable. So we have gotten more constructive there. SBI has been doing well. We believe is still undervalued, and the growth profile is still very strong. Larsen similarly is a good mix of infrastructure as well as play on IT, because they have, the subsidiary on the IT side, and both the businesses are doing well. Maruti, we believe, again, will benefit from rising discretionary consumption, and automobile sales generally have been weak. We expect that to pick up. So if you look, the 2-year earning CAGR is quite strong even for large caps, but some of the mid caps is where we are very confident, and you will see names like, say Apollo Hospital, 27% CAGR, Torrent Pharma. So most of these mid and small cap companies which we are holding in our portfolio over next 2 years are going to compound at 30% plus on earnings. Some of them, obviously, even on valuations, would therefore be expensive. But again, we have been very conscious of how much are we paying for those companies relative to the growth. And if some of those companies can grow at those growth rates for next 3 to 4 years, we believe these valuations are justified. So, this is in a nutshell, just the gist of how we have constructed, what's the thought process behind this portfolio. We'll be happy to take more questions in the Q&A, and if you want to delve deeper into any aspect. Thank you. Thanks, everyone.
Thank you, Mr. Relly and Mr. Lochab, for those valuable insights. I now request our leadership, Mr. Relly, Mr. Rathi, Mr. Lochab, and Ms. Bhatia to join us on stage, as we will now open the floor for questions from the media. I request our journalists to please raise your hand, and our team will bring a microphone to you. We also request you to state your name, your organization, who the question is addressed to in particular, please.
Hello, I'm Sundar from Business Standard. My question is to Mr. Relly. So HDFC is celebrating 25 years. What has been your biggest hits and misses, if you look back, of HDFC Securities? And secondly, bank-based, bank-owned brokerages like you had a distinct advantage before this pre-pandemic boom in the broking business. But the new age companies, the discount brokers took, basically they gained more than brokerages like yours. So what really are the takeaways from that? And going forward, how do you see your business? Will the focus be on generating more revenues, or by targeting high net worth clients, or are you going to focus more on adding more clients? Yep. Thanks.
So Sundar, you've asked me all possible questions on the broking industry in just one question only. Thank you for that. I'll take first the last question. The segments we'll focus on, I think we will focus on all possible segments, and we believe that we have digital properties, expertise, and also understanding of all the segments in place. We have been full service brokerage house, so we'll continue to put our thrust on full service brokerage house through our brick and mortar ecosystem as well as through our digital properties. I can tell you that we've seen a lot of disruption coming in from the discount brokerage houses, but despite this disruption, we've seen that customers have progressed very well with us. They have shown their trust, their confidence, and they are aligned the way we operate and help them in their wealth creation journey with us. That's how they have been with us through and through in this last 25 years and growing also. So we'll continue to focus on full service brokerage house. At the same time, we do acknowledge that the tech-led discount brokers have done tremendous job in democratizing the investments and making it accessible at lower cost. And there are certain set of customers who are price sensitive, cost sensitive, and also a lot more digital savvy, and are only looking at digital properties to help them in executing their decisions. And that's where we've launched HDFC Sky, and we believe that we will disrupt the disruptors with HDFC Sky application. And we've already acquired in last 15 months more than 1.8 million customers in HDFC Sky, and we'll continue to acquire more customers. Our thrust is always to add value to our customers. Even in HDFC Sky, which is a discount broking platform, we do offer research. HDFC Securities in-house research, captive research is offered to all discount broking customers also. At the same time, we do have a product like margin trade facility also available for all our customers in HDFC Sky also. We realize that there is a niche space on advisory side where customers are looking forward for advisory services, and that's where very recently we've launched HDFC True, our advisory services. Just about 7-8 months ago, I think in this room only we've launched. Some of you were there at that launch event also. In last 7-8 months, we could able to grow our AUM, asset under advice, to over 10,000 crores. We believe it's a very niche space and it requires a lot of expertise, honesty. We'll build this business brick by brick and try to make this as a business that will act as a benchmark for not only industry in India, but also globally. So we'll continue to focus on all possible segments. Regarding your first question, Sundar, on takeaways from the last 25 years or learnings in last 25 years, I think the biggest takeaway is that the transaction-oriented businesses are up for disruption, something we have seen in the broking space and also in the payment space also. If you see in the payment space, there are fintech players who have disrupted despite banks are also offering all possible payment services. However, it is difficult to disrupt the fund-based activities, as hardly any fintech player is able to form a significant disruption in the fund-based activities. So this is one learning. Other thing is that our takeaways are that the customers are really looking forward in mid to long run a value addition coming in from the partners or brokerage houses or distributors. So that's where we believe that they may have a consideration on cost for the some time, but at the end of the day, in mid to long term, all that they value is what kind of a value additions are coming from their partner entity. And whether it is in the form of digital properties, real-time insights, through the innovative method of engaging and connecting with them, or also through the active relationship management also. Most of our customers are still skeptical about where to invest, when to invest, how to book profits, what kind of asset allocation they should have, what kind of diversification they should achieve. You know that asset classes like gold have done so very well. India have been investing into the gold in physical form, and off late in last 10 years, with the advent of gold ETFs and sovereign gold bond, Indians have taken exposure into the some of these asset classes through different products also. I mentioned in my address that portfolio management services and alternative investment funds and even unlisteds have got the fancy or attraction of many of our customers. So cutting long story short, I strongly believe that there is a significant room for us to add value and differentiated value to our customers, and we'll continue to focus on the same.
Hello. Good afternoon. I am Mehul Dani from FinTech Biz News. What are your insights with regard to FPIs and high net worth individuals? Secondly, how well you have been able to deploy the technologies, specifically customer-facing technologies, which act as a market differentiators for your company? Thank you.
Again, I'll take second question first. I think we take a lot of pride in innovation and bringing in the best-in-class technology, digital properties for our customers. Our InvestRight application is one of the best application. It's rated 4.5 plus on App Store and Play Store. And it is loaded with the features. I would humbly request you to go through the application, open an account with us, or otherwise see the application. It brings in all possible asset classes. Customer can just start the journey in 5-7 minutes only, and after that it's very easy for them to invest in direct equity, derivatives, mutual funds, and all other products that are available on the application. We also have a portfolio which takes care of the corporate actions. We have features like XIRR, where customers can get to know about their annualized returns. So we have almost everything available to them. We do provide real-time insight to our customer through the in-app notifications, emails, and also through the price alerts mechanism. We have inbuilt strategies in the derivatives for the customers so that they can take informed call. They can know well in advance that what kind of profits they can make in particular trade, and what kind of possible losses can be there also. Similarly, we have bracket order, basket order, and many more features that help customer to manage their portfolios, manage their investments and transactions very well. And all these features and more are there on HDFC Sky also. In HDFC Sky, we have, we do have also commodities available to them also. Very soon we will launch the same in InvestRight application also. And also they can invest into global stocks through a partner relationship. We have partnered with the couple of fintechs to offer global stocks. Customers with this same convenience can invest in Indian equities and Indian financial products as much as they can invest into all possible stocks that are listed on US, ETFs, and many more products. Your first question was on the FPI side and the HNI side. I think HNI side, we've seen a significant resilience and evolution in their understanding. I've been in this industry for last 25 years. In early 2000, around 2008, there were a lot of skepticism. People would panic when there are market corrections. So behaviorally, HNIs have evolved significantly. Their risk appetites have also increased. They have learned the way to navigate the volatility in last 20-25 years. And today they have understood that they will sink and swim with the market, and they are willing to do that. They are not panicking when there are corrections in the market. In fact, they are always keeping their powder dry to use these kind of opportunities to invest more whenever there are significant corrections or some events in the markets, whereby they strongly believe that they may have a short-term negative impact, but long-term it will help them to create their wealth also. They've also got a lot more understanding about the stocks, portfolios, and mutual funds, and many more products also. So today we face a lot of intelligent questions from our customers also. They are no more just looking at the recommendation. They are also looking at why are you recommending this particular company, and why do you believe this company will do well, why this stock will do well, and what valuations are there, what is their business model. So there are a lot of engagements happening on that front. As far as FPIs are concerned, I think they have been a pillar in the Indian capital market story, and they've been investing in quality companies. And our take is that they will continue to find India as an attractive destination to invest. Unlike Indians, where the liquidity is married to the Indian markets largely, and very limited liquidity goes to the overseas investments through LRS route, FPIs have multiple options available to them. They can invest into any markets. They can invest into the different asset classes also. So from time to time, they continue to take their decisions on which markets are more attractive, and that's how, or which products are more attractive, where they see more risk reward favorable, that's where they invest. But in short term, last year we've seen them taking out a lot of money from Indian markets. Recently they've started to invest more. I believe that it's hard to bet against India.
Hi, I'm Dipti from Mint. So my question is to Dheeraj and Varun sir. Given the market decline today, do you think it's closely linked to the India-Pakistan escalating tensions? Also, from a slightly medium-term perspective, where do you think India is placed? Do you think that money would flow from the US into Indian markets along with maybe other markets like Japan? What's your perspective?
See, I'll break my answer into two, Dipti, that one, in the long run, markets are slaves of earnings. We are all aware of that. In short term, there could be an impact because of the market conditions. There could be impact of geopolitical conditions or maybe across border activities. So to that extent, it may have its own negative impacts on the markets and we may witness more volatility. But I think in the long term or mid-term, we believe India growth story is absolutely intact and all possible high frequency indicators are like GST collections, direct taxes collections, in fact, projection of IMD on more than normal monsoon, 105% of the long-term average. All these are favorable indicators. In fact, we have managed the inflation also very well. Inflation currently is now below the RBI expected number. And to that extent, leave some room for the rate cuts. We've witnessed 50 basis rate cut in the last few months. And we believe that we are fundamentally strong. Of course, in mid-term, short-term, if there are escalations, it will have its own impact on the markets. Varun, if you want to add more.
Yeah, I think just to add, not much to read into one-day movement. If you look at, in 3 weeks, not even 3 weeks, probably 2 weeks, we are up 10% from the low which we had made on the tariff announcement day. So, the rally was very sharp because risk-reward was starting to get attractive in certain pockets. And what we have been saying anyway, at the start of the year, we were cautious on the full year outlook, given how, valuations were looking stretched in a lot of mid and small caps in particular. And we saw a fair bit of correction in, in the first quarter, Jan to March. There was a very sharp correction. These days, typically, the movements have become very sharp because of, the information asymmetry not being there. And, after that correction in April, we have seen things picking up. And even in terms of earnings, and what we said at the end of March was that probably now is not a time to be overly bearish on equities. I think the time to be slightly more cautious and bearish was last year when things were, looking too, too stretched. But now, in terms of earnings, while we may still continue to see some downgrades, the pace of downgrades won't be as sharp in FY26. Secondly, on flows, I think FPI outflows also, you will start to see that number sort of stabilizing. So last year, we have seen a lot of FPI outflows. We did one analysis where, historically FPIs have not sold to this quantum for more than 2 consecutive quarters, barring GFC, which was way back in 2008 when, the actual event was really big. I think if I take that out, then the extent of selling we have seen from FPIs in the last 2 quarters, more or less, makes us believe that we are at the fag end of FPI selling. Now, that doesn't mean that they will jump in and buy very aggressively. I think that will be a case of, how relative valuations look. Certain other economies are still more attractive on that basis, but the medium to long-term growth prospects of Indian economy are still one of the better ones. When we talk to FPIs, we don't see them concerned on that aspect. So therefore, again, FPI flows, you have to look at it in 2 buckets. One is, the really sticky long-term money. Out there, we have not seen any change of views and they continue to happily hold India in their portfolios. Second is the more tactical, hot money, as we call it, which would be, trying to take that 10% sort of moves in various markets, and that tends to be volatile. And that money still may not find India too attractive in the relative scheme of things, and therefore aggregate FPI inflows may still be muted, but it would be much better than FY25. So in a nutshell, macroeconomic parameters, earnings, valuation and flows, all four at the margin are looking better for FY26 compared to what they were in FY25. But at the same time, none of them are so strong that one should get overly bullish on equities. But we believe, there is nothing to be bearish on equities. One should maintain their asset allocation. On dips, one should look to buy. The medium to long term fundamentals are still strong. We are able to find enough good ideas after this round of correction. So we are, continuing to work out with that kind of a view.
Actually, I have a follow-up. So if tensions with Pakistan heat up a little more than what it is today, do you think it would be a big bother for markets?
Not really. See, if you look at, will it really impact earnings? Because as Dheeraj said, ultimately markets tend to get impacted only when earnings take a beating. Frankly, we have had these kind of issues in the past also. In the in the last 5 years, we have had one or two such instances. In fact, whenever the reasons are something which are not related to real fundamentals, they tend to get sorted really soon. Tariffs is again one example. While that still would have impact on earnings in our view, India-Pakistan thing has very limited impact on earnings. So these are more, sentiment things which tend to impact some of the, money at the margin. Like, some of the retail money which just came into the market, they tend to get worried when these kind of events happen. But frankly, we see this as a non-event from a market perspective, from a medium term. Like, 5-7% corrections here and there, or up moves can happen at any point because of sentiments. But for anything sustainable or bigger than that, it has to be backed by a real earnings impact.
Hi, so this is Anisha from Money Control. I have a couple of questions with regards to the report. So one thing I've seen is that you don't have any private banking names in the thing. I mean, BFSI is a very small, a few names you have. I mean, you have State Bank, which is obviously PSU that's there, but you don't have any private bank names over there. So is there any particular reason for that? And I'll ask you after.
Not really. See, as I said, the idea was not to have a equal representation or something what the index has. So BFSI, as you see, is around 16% weight, which is much lower than what Nifty has, but it is more in sync with what, say, BSE 200 has in terms of the BFSI weighting. And we continue to be positive on quite a few private sector banks, like ICICI, is one of our top picks. Even Axis we have in our model portfolio. But, the idea was not to own 40% banks, because then it becomes a tactical thing that the moment we get slightly negative on banks for whatever reason, this is a portfolio which is a medium term buy and hold. SBI, we believe, is doing as well as any of the private banks on most parameters, and is, in terms of valuation, it is at a fairly good discount to some of the private banks. So while, ROA is lower than that, the valuation discount is even steeper. So we believe, SBI provides you a good alternative to kind of play the banking story. But nothing against private banks. We are overall positive on them as well.
And I also wanted to ask you, I mean, you have a pretty much equal number of, large cap and mid cap names that are there. And also in terms of, investor interest also is pretty much still there within, the small and mid cap space. So has the skepticism or the concern regarding small and mid caps, has that gone away? Because even if you see shareholding and all that stuff, investors are, looking to invest into small and mid cap majority. So how do you view that?
So see, at the start of the year, when we did meet, we were cautious on small and mid cap, and what we said in our model portfolio almost 65 to 70% we were in large caps and only 30% was in small and mid caps. Even though we knew that, small and mid cap correction would happen, we didn't sell those 25-30% holding which we had in small and mid cap. And the reason is, when one is looking from a 3 to 5 year perspective, it's sort of absolutely necessary for wealth creation that you need to have certain good small and mid caps names in your portfolio, because they tend to outgrow the large caps in terms of earnings if they are well run, right? Because of the lower base, their ability to grow is higher. So first of all, we were never in the camp that small and mid cap should not be a part of the portfolio. We believe they should always be a part of any portfolio which has a slightly longer the time horizon, longer should be the proportion of small and mid caps in your portfolio. But at the same time, in small and mid cap, it's very, very bottom up and stock specific. So what stocks you hold is of paramount importance. Like, if you are stuck in the wrong stocks, they can fall 80-90% and never come back. So therefore, I think small and mid cap investing has to be done by experts and people who know those companies in and out. Compared to that start of the year, after this correction in Jan to March, definitely we believe a lot of the small and mid caps, I would not say that they have become dirt cheap or very attractive, but I think a lot of the mid cap and small caps have seen a good healthy correction, and from here on we are seeing good positive risk reward. Like, just to give an example, in December end, if we were finding only 10% of our mid and small cap universe as worth investing, today at least 40 to 50% of those have come to a point where we are getting positive, and we are happy to invest in them from a 3-year kind of a perspective. So with that context, in this portfolio, almost the large cap and mid cap is 55-45. So in that sense, we have increased our mid and small cap sort of a holding compared to what it was in the beginning of the year, and we believe that should be the case given the correction which has happened. It's still, I would say, if it was a COVID kind of a correction when small and mid caps had become really attractive, then probably it should have been more like 60-65%. We are not there yet. But if there is one more round of correction in some of these small and mid caps and we find more ideas, we'll be happy to increase it further.
Thank you.
Sir, what is your current market share in the brokerage space, and how do you propose to enhance it in the current FY?
So different segments have a different market share. We've always been focusing on wealth creation of our customers. In retail segment, cash segment, we have double-digit market share. As I mentioned some time ago, in the margin trade facility, we have double-digit market share. In derivatives, we've not been actively working on that space, so we have a lower market share. Having said that, through HDFC Sky, now we are looking forward to gain more market share in the derivatives also. I think we don't focus so much only on gaining market share. Our thrust is always to add value to our customers, and market share and revenue are byproduct of our engagement and our advice and our recommendations to our customers.
My question is to Mr. Varun. Sectoral leadership was one of the criterion for those 25 stocks. So have you also considered the players within the listed space who could become challengers, have potential to become challengers to these sectoral leaders, or come as a number 2?
Correct. So as I said very clearly in that presentation, that so we have chosen some sector leaders where we believe their leadership or their sector leadership will not get challenged to a large extent in the next 3 to 5 years compared to how things were, say, in the last few years. So that's one. But at the same time, we are always looking for challenger companies who can outgrow, the industry and gain market share. And therefore, a lot of these mid and small caps fall in that bucket which we have chosen. Some of them are there in large sectors with a small market share, and we are given our expectations bottom up on some of those companies, we believe they will be gaining market share, and that's reflected in much higher earning growth for those companies. And in certain cases, we may not have they might be a sector leader, but they are in a sector which itself is small, so they are mid and small cap, but they are sector leaders, like, in their own respective subsectors. So a lot of the stocks you will find it that way. So therefore, while they may be, looking like mid and small caps, they are sector leaders, and therefore, if I do an aggregate of how many of these stocks are sector leaders in their respective subsectors, it would be a much higher number than those 6 or 7 stocks, mega large caps, which you are seeing as sector leaders. So, idea is to have a combination of both. But what we have seen is, if a sector leader kind of continues to execute well, there is a natural tendency for them to gain share. The big keeps getting bigger in most of the sectors because of the better resources, better capital allocation, better ability to attract talent, and therefore, in a growing economy, a sector leader, because it's not like the West where the industries are not growing at all, and therefore you need to look at more challenger names to get that extra growth. In India, even a sector leader, if he is managing the business well, can continue to grow in double digits easily. Then it makes a lot more sense to be with a sector leader, in those spaces, if they will, continue to grow double digit. So it's a good mix of having sector leaders in the portfolio, at the same time having some companies where there are some bottom-up reasons why next 2 or 3 years, given their plans, they can outgrow the industry and gain some market share. So it's a combination of both.
And one more thing, does sector leadership guarantee that the stocks or wealth creation through stocks? Because considering a lot of PSU names are sector leaders, but the stocks don't give that kind of returns. Like again, some of the other. So how does one navigate this?
So that's why you see, we have got sector leaders, but we have to look at their earning growth. So if they're a sector leader with a 5% earning growth, which means maybe the sector itself doesn't grow very high. Some of the oil and gas PSUs or some of the other PSUs may fall into that bucket. So we have not kept those in our so the idea is not to choose every sector leader. The idea is to choose sector leaders which meet those 2 or 3 additional criteria, which is, one, we should be confident that they will continue to maintain their sector leadership 3 or 5 years out. Secondly, the industry or the sector they are in has to have a growth which is respectable enough for us to get a double digit minimum earning growth for you to kind of to invest in those. Otherwise, there is no point in being a sector leader with a flat or a very low growth. So, therefore, you will see that a lot of the sectors, we have not picked sector leaders. So, it's not that in every sector we have gone and picked sector leaders. So, it's very cherry picked in that sense.
Sir, my question is for Ms. Bhatia. Ma'am, can you share a little about the initiative of Know Your Money? I'd like to know about the timeline, the response for it so far, and you've aimed to impact the lives of 25 million people. So I just want to know if there's also any conversation about including AI as part of the financial literacy in that initiative.
Okay, so so far what we've done is we've started at a small scale. So we started with schools in Maharashtra, and as we shared the number, Ashish had shared the numbers, we've been able to reach out to 100,000 people at this point of time. With the launch of the mobile app, that's the entire objective, saying through a digital app, we would want to reach out to at a much larger scale, and that is where we will use both the digital abilities and our expertise in terms of being able to demystify, make it simple, make a financial complex simple for them. So that is the way we would want to look at it. AI at this point of time, we are not targeting, at least in this year, because as I said, this year, the focus will be a lot more on making the content simple and making the content very interactive. So we're taking that first step in terms of helping the segment really understand what is finance, how do you start your savings, how do you start making financial goals, etc. So probably AI, I think it's a good idea. Probably next year when we've reached a certain scale, we can see how we can leverage that.
Thank you, thank you.
Okay. My name is Ayush and I'm from Finite Media. I have a question about how do you find those stocks, for example, Airtel or Avenue Supermart, which are in their recent times, they were not posing threats to larger stocks, but currently they are actually in a big hub. So at their starting period of time, so like how do you figure out those types of stocks which are actually going to pose a big threat into their on the like large companies?
So see,
and keep it in your portfolios. Sorry.
Yeah. So the portfolios obviously have to be dynamic and have to be evaluated. Obviously, we do evaluate our model portfolios every quarter, and every retail investors we believe should also be doing at least, if not quarter, then 6 monthly, because a lot of things keep changing, which which actually changes your investment thesis at times, and therefore you need to respond to those changes. I think as I said, say Bharti Airtel, classic example, market leader. It was the market leader even earlier, but it was going through a period when the industry was going through tough times, but they maintained their sector leadership, and valuations were quite attractive then. So it made a lot of sense for anybody to own Bharti Airtel, and we also had it in our model portfolio for a long period of time. Now, just to give you an example, it's not part today of this 25 list, because now we believe a lot of those positives have been discounted and valuations are on the higher side. So as I said, in large caps, we tend to look at valuations very closely, because some of those sectors we know will not keep growing at a very high pace, given sort of the fact that some of those companies are really big, and therefore the growth rates are more or less predictable. But when valuations go really off the charts, sometimes because of those companies doing well in the recent past, we tend to avoid those large caps, and we tend to wait for better entry opportunities in those quality business. So Airtel is like in that camp right now, where we believe valuations are run up slightly ahead. In case of DMart, again valuations was a big issue for us to not own the stock for the last 3 to 4 years. In fact, we didn't have a positive rating because of valuations, even though then other issues also came by in terms of quick commerce impacting them. So it's like competition is another variable which you have to keep in mind when picking these stocks, that these days you don't know where and how competition comes and hits you, and therefore buying stocks with a valuation or a margin of safety comfort becomes very paramount, because while today they might be market leaders and they might be very strong, you never know how a new competitor comes in and starts disrupting them. So you have to be very conscious of some of these things, and at the same time be very conscious of valuation that you are paying, because if you are stuck even in a good quality stock at the wrong valuations, there might be a decade when you make zero money. Just in case of say Bharti, 2007 to 2017 it gave you zero return. In case of Unilever, 2000 to 2010 it gave you zero return. Now again Unilever 2020 to 2025 has given you zero return. Not to say they are not sector leaders, not to say they are not great companies, but it's just that you bought them at the wrong price. So it's a combination of growth, valuations, quality, everything has to kind of fit in together, and you will still go wrong, and that's where you need to keep reviewing the portfolio and make sure that if things have changed on the ground, if anything has changed to challenge your investment thesis, then you make those changes in the portfolio.
Hi, Anjana from Informist here. My question is regarding, so first of all, congratulations on your journey. My question is about the derivatives segment. SEBI has been increasingly tightening its norms in the F&O space, right? So my question is, sir, throughout this journey, you have had your fair share of learning, as Mr. Dheeraj said. What are the risks or challenges as a service provider that you see in the derivative space, and what needs to change, whether it be in terms of financial literacy, whether it be in terms of regulation, what are the things that should improve or what are the things that should change?
I think in last few years, we've seen exponential growth in the derivative as a segment in India. I mentioned that NSE is the #1 stock exchange in the world in derivatives. There were exuberance. Many new investors, particularly young investors, were coming to the market and trying to make money in short term. And they were speculating in the market without understanding the derivatives. There were more than required expiries in the that is leading into more and more speculation also. So SEBI has made some right interventions to ensure that we can deal with the exuberance in the derivative space. There's a lot of work to be done by regulators, exchanges, us, you guys, to ensure that we educate customers, we inform them that what kind of risk they carry in some of these transactions, particularly when you are not aware that it can lead to a significant capital erosion. Then it is very important that we educate our customers well. So we've been very, very conservative in this space. Unlike other brokerage houses where 70 to 85% of their revenue comes from derivative, for us it's just about 15% of our brokerage revenue comes from a derivative space. So we have been prudent. The other things what can be done is to do a suitability exercise when you're onboarding customer for derivatives. Like when you are allowed to drive, you need to go through a driving license. Similarly, a suitability exercise, a simple suitability exercise can be done, which could mean basically that they should have a somewhat understanding of the product. They can go through a basic certifications, or they have adequate experience in the market. Some of those things can be done, maybe on the anvil also. But as of now, whatever interventions are done, I think they are good enough to deal with the exuberance in the derivative space.
Thank you.
Hi, I'm Akshita from the Hindu Business Line. Building on what she said, and like you said, derivatives is not a huge portion of your revenue, but as a whole, the broking industry has struggled a little with pressures on margin and volumes from these F&O rules, which, while warranted, have impacted. So how do you see brokers to be able to manage this pressure from reduced volumes? Like if Ashish sir or Dheeraj sir could help me with this.
So if you look at the particularly the regulatory changes which has happened, I think so over the past few days, I think the derivatives was one of them. I think the true to label was also an equal factor, wherein basis volumes brokers were getting advantage of the discount which was passed on by the exchanges to the brokers. And the third one, which I think so was not noticed by the media also, is the basic demat services account, which I think so which the limit was raised up to 10 lakh rupees. And the brokers actually on the AMC can charge only up to 100 rupees. So that also led to some 25 to 30% reduction in the income on the demat services. Obviously, derivatives has its own share of volume reduction, plus the true to label, which also had an effect on the bottom line for the brokers. Now to navigate all this, 2-3 things brokers can do. I mean, the simplest one is to increase the charges, which I think so, if you look at in bits and pieces, while the charges have remained 20 rupees per order largely, but however, some of the brokers which were not charging on delivery have started charging 20 rupees per order, plus you have a percentage or 20, whichever is higher, so then that percentages have changed. So in bits and pieces, some of the brokers somewhere have started increasing the charges, but in the long run, if the pressures remain same, see if the markets were to improve, volumes were to improve, I think so everything can be done. But however, in the larger space of things, to retain the margins, I think so somewhere someone will start making a move to increase the charges. That remains the only option, because brokerage, finally, it's a fee income. It's not a, I mean, you build a book like a funding book and keep earning. So it's not an AUM business. Brokerage is like a daily transaction business. So one of the options is to increase the charges for brokers. Second option is, I mean, not much, but yes, the brokers can look at some cross-selling or a distribution model which can yield them some kind of revenue. So this is what we feel.
Hello. Sorry. I'm afraid that's all the time we have for today. Thank you so much to our leadership. Thank you to all the members of the media for your thoughtful questions and for being part of this milestone event. On behalf of HDFC Securities, I extend our heartfelt gratitude for your continued support and partnership over the past 25 years. We invite you to join us for lunch and networking, where you can interact further with our leadership team. Thank you once again, and we look forward to building the future of investing together. Thank you.